Hey guys, welcome back to Fisk Financial. I'm Eric Fisk, and today's video topic is all about investing. I'm going to start out by giving you a quick overview of some of the most commonly used tools and vehicles to start investing, and we'll wrap everything up with my personal recommendation for those who are just getting started. In thinking about this video, I recalled a conversation I had with a friend a couple of years back. This friend is someone who had been getting by fine for a number of years. They weren't struggling by any means, but they also didn't have a lot left in their bank account after bills were paid. They were doing a number of odd jobs to make money and kind of hopping around looking for what really interested them. Eventually they found a career that they were really passionate about and started making a pretty decent salary. As a result, they started to see more and more money piling up in their bank account and didn't really know what to do with that. So this is really where the conversation started. There was obviously a knowledge there that they should be investing that in some way in order to set themselves up for retirement or make their money make more money for them, but there wasn't really a clear understanding of how to go about doing that. I think this is a pretty common situation for a lot of people as they're just starting out in their careers, or they find themselves making more money and they want to start investing but don't quite know how to attack that. So I'm going to go over some of the most commonly used instruments for investing. We'll talk some of their pros and cons and where they fall into most investment strategies. I'm also going to kind of rate these as we go through them and how much I like them as an investment vehicle versus how much I don't, and I'll kind of give my rationale there. So first on the list is probably one you've heard of before, and that's bonds. Now, bonds come in a lot of different flavors, but they can generally be issued by government entities like US Treasury bonds or from corporate entities. Bonds are also given a rating from an independent rating company based on how safe of an investment they're viewed as. Typically, government treasury bonds are seen as very safe and not going to default, while some lesser-known corporate entities may have lower ratings due to less of a track record or seen as more of a risk for default. Generally, the interest rates on these bonds reflect their rating, so if they are considered a very safe bond, the interest rate is probably going to be a little bit lower, versus a more risky opportunity is going to provide a higher interest rate and therefore higher payout. The way that bonds work is literally you're basically giving a loan to this corporate entity or to the government for them to go and then spend against their business and hopefully increase revenues. So you as the purchaser of this bond are kind of acting like a bank to this corporation. In turn, that corporation is going to promise to pay back that loan to you once the bond matures. And bonds can really range any time period for their maturity. Typically, you'll see 1-year bonds, 3-year bonds, 5-year bonds, 10-year bonds are very common. So let's say you buy a $1,000 bond with a 5-year maturity on it. The promise from that corporation is that after 5 years of holding that bond, they're going to pay you back that $1,000 that you invested. Now, that alone doesn't sound like a great deal, so that's where the interest rate comes in. Every bond is going to have an annual percentage rate assigned to it. This is a promise that for as long as you hold the bond, you're going to be earning that percentage rate every year. So again, as an example, a bond with an issue price of $1,000 and a 10% annual rate of return is going to pay you $100 every year that you hold that bond. That can really be paid at any interval that's established on the bond, but typically semi-annually is pretty common. So if you're holding that $1,000 bond for its entire 5-year maturity, you're going to make $100 a year, which will be $500 over the course of the bond, and you're going to get paid back that $1,000 at the end of the 5-year period. So in total, you would have made $1,500 from a $1,000 investment over the course of 5 years. Now, in this example, a 10% rate of return is not really realistic. Bonds typically have a much lower rate of return, and that's because they have a direct correlation with interest rates. Currently, as you may be aware, interest rates are at all-time lows, so it wouldn't make sense for a corporation to issue you a bond with a 10% interest rate when realistically they could probably go borrow money from another source or an actual bank for somewhere in the 3 to 4% interest rate range. So right now, US Treasury bonds have a really low interest rate in the 1 to 2% range, and this is the main reason why I don't recommend this as a sound investment strategy. So bonds actually have an inverse relationship with interest rates. That is to say, if interest rates go up, the value of your bond would go down, whereas if interest rates go lower, the value of your bond would go up. So with us experiencing record low interest rates right now, the chances of this dropping any lower is pretty slim, which means the only way that this can go is up, which would drive the value of these bonds down even further. So if you're looking to invest right now, bonds probably is not the way to go. I'm going to rate these investment vehicles with Fisk faces, and I'm going to give this a pretty poor one of 1 Fisk face. Our next investment vehicle we're going to talk about is individual stocks. Stocks are traded on an exchange like the New York Stock Exchange, and you can buy them through different online brokerages. What a stock really is basically you buying a small percentage of a company. So if you were to go and buy some Apple stock, you would now be a small co-owner of Apple. The big risk with buying individual stocks is that you're placing a big bet on that company to do well. If they don't do well, your stock value goes down and you lose money. On the flip side of that, you can end up making a lot of money if the company ends up doing really well. But let's talk about another example. You may remember back in the early 2000s, there was the dot-com bubble. This is when the internet really started booming and there were tons of businesses opening up and going public with .coms in their name. And there was just a flurry of investors looking to throw money at these companies without really knowing what they did or what longevity they might have. Well, inevitably, a lot of these companies went belly up and don't exist today. So anyone who bought stock in those companies at that time, their investment essentially went to zero. Of course, there are examples coming out of this like Google or Amazon that did exceptionally well and would have made you a lot of money if you had bought them early on. But for every Amazon and Google, there's 1,000 other companies that, like I say, went belly up and no longer exist. So the risk with individual stocks is that you're just not diversifying your portfolio very much. Unless you're going through and buying hundreds of stocks on your own, which is extremely time consuming, having to research all these companies, not to mention expensive, having to pay brokerage fees when you buy and sell stocks. The other psychological disadvantage to this is emotional swings when stocks fluctuate. If you go and buy a stock which in the next week has a bad earnings report and ends up tanking 20%, you might kind of freak out if you put a lot of money in that. What a lot of people do when they see this happen is they sell the stock at a loss only for it to inevitably go back up. Suffice it to say, it takes a really strong will to not do this, and I really only recommend buying individual stocks if it's money that you really aren't concerned if you lose. Obviously, no one wants to lose money, but if you are going to go and buy individual stocks, I would consider that money as kind of fun money that may be there tomorrow, maybe it won't be, but it really shouldn't be the cornerstone of any investment or retirement strategy. I'm going to give individual stocks 2 Fisk faces. Our next investment vehicle is mutual funds. Mutual funds are basically a big basket of securities that are managed by an investment professional. They can contain anything from stocks to bonds to commodities, and some of them will even follow an index of a certain industry or sector. The benefit of mutual funds is really that you're pooling your money with other investors so that you can buy into hundreds or sometimes even thousands of different securities or stocks at the same time. So it gives you buying power that you wouldn't have if you were to go and invest in these companies on your own. If you and thousands of other investors are investing money into a mutual fund that's focused on, say, the tech industry, you're potentially buying fractions of hundreds of different stocks that you wouldn't be able to do on your own. This gives you an immediate diversification in the market that you wouldn't have with buying individual stocks. The downside to this is that most mutual funds are what is called actively managed funds, which means that the investment professionals that are running them are constantly making trades to try and beat the market and make their fund overperform. This obviously requires a lot of time from the investment professional running the account, so the exchange ratio is generally a lot higher than on some more passively managed investments. Generally with mutual funds, you're going to be looking at a minimum of about 1% management fee, in addition to some funds that may even charge a commission on your initial deposits. I'm going to give mutual funds 3 Fisk face because they are a sound option, but personally I think there are better options with lesser fees on the market. Next on the list is index funds. Now, index funds are technically a type of mutual fund. However, they usually don't seek to beat the market, but rather track a particular index within the market. There are tons of different indexes to pick from. You can pick from tech stock indexes, from green energy indexes. You can pick indexes that focus primarily on bonds. But the most common indexes are usually those that track the S&P 500, which is the 500 largest companies on the New York Stock Exchange, or index funds that track the entire stock market as a whole, and even index funds that track international markets separately. These types of index funds are structured on the idea that over the long term, the market is going to win out. Generally, index funds are also what's called passively managed. That means we don't have a fund manager in there that's constantly making trades trying to beat the market, so there's not a whole lot of activity going on in that index fund, which means that their expense ratios, or what they charge you to hold the fund, are generally a lot lower. There are a number of index funds out there that only charge 0.25% annually, or some even less. As a matter of fact, some online brokerages even have a 0% expense ratio on some of their index funds, meaning you pay nothing to have them manage that money for you. Index funds get a 4 rating as a great option. Next on the list is ETFs, or exchange traded funds. ETFs actually operate a lot like index funds, with the main difference being that they can be traded on the open market throughout the trading day, whereas index funds and mutual funds can only be traded at the close of the trading day. But similarly to index funds, ETFs usually track an index, which generally means they fall into those passively managed accounts which don't cost you as much to own and still provide a great diversification. ETFs are also a great option and they get a 4 rating as well. So there's a quick rundown of some of the most commonly used investment vehicles, but now I'm going to give you my number 1 recommendation for if you're just starting out investing. A Roth IRA! Super exciting, I know. A Roth IRA, or individual retirement account, is my number 1 recommendation because it's a tax-advantaged account that can give you the diversification like some of the other options we talked about in index funds and ETFs. With a traditional IRA, you'd be putting in those pre-tax dollars and then your investments could grow in the account. However, when you take money out of a traditional IRA, you're paying taxes on the entire amount, contributions, and your interest earned. With a Roth IRA, you're contributing after-tax dollars. However, the big benefit is when you go to take those dollars out in retirement, you're not taxed on anything, not your contributions or your earnings. This could end up translating to a lot more money in your account in retirement because we really don't know what taxes are going to look like 20, 30, 40 years from now. Another benefit with a Roth IRA is that you can take your contributions out of the account at any time without penalty. So if you did end up falling on hard times and needed that money back, you could withdraw your contributions without having to pay an additional tax or penalty fee. Now, because this is a tax-advantaged account, there are some limitations on when you can withdraw those earnings. Specifically with a Roth IRA, earnings can be withdrawn once the account has been open for at least 5 years and you meet at least one of the following additional criteria. You can take money out for buying your first home, up to $10,000. You can also take money out for qualified education expenses. You can take money out for certain medical expenses or long-term unemployment situations. And most commonly, you can take money out once you reach the age of 59 and a half, heading into your retirement. There are also limitations on how much you can actually contribute to an IRA throughout the year. The limitation for 2020 and 2021 is $6,000 for the entire year. And that's across any type of IRA account, so if you have a Roth and a traditional, you can only contribute $6,000 across both of those accounts. That right there should really tell you why this is such a great option. The government has to limit how much you're allowed to put into that account because you're getting a great deal getting tax benefits on that money. So in terms of how to open up a Roth IRA account, there's really a number of different options. Pretty much any online brokerage will have Roth IRAs as an option for you. You can go to Vanguard.com or Fidelity.com or Charles Schwab. These are some of the big ones. They all have options for IRAs. However, if you go this route, you're really going to need to pay attention to the fees, as most of these online brokerages are going to give you the option to either self-manage your account or they will manage it for you. As you might expect, if you choose to let them manage it for you, there's going to be a larger fee associated with that versus if you fund the account yourself and then pick whatever stocks, retirement funds, index funds you want. There's certainly nothing wrong with going this way, and you can definitely do this on the cheap by picking the right index funds. But if you're someone who really is brand new to this, you might not feel comfortable doing this on your own. And that's where I think there are better, simpler options available in the form of robo-investors. Now, not to throw another weird new term at you this late in the video, robo-investors really aren't as crazy as they sound. This isn't like drones dropping from the sky and taking your money. Really all it is a professional investment firm that's using data and algorithms to invest your dollars. The two most commonly known and used are probably Betterment and Wealthfront. I personally use Betterment.com for my Roth IRA. I'll go ahead and link my referral code down in the description below. If you do end up using that code, we'll each get some free management time on our account. But even without that, the management fees are very reasonable. Betterment charges a 0.25% annual fee, which for every $1,000 you have invested equates to about $2.50 a year. Not that bad. Both of these companies have really simple interfaces to understand, and they also both have apps that you can use on your phone to link your bank account, set up automatic transfers, and try and reach that maximum contribution of $6,000 a year. One other really nice thing about using this type of a Roth IRA account is you can generally transfer these pretty simple. If you decide you don't like whatever firm you're with, you can very easily transfer to another firm without any penalty and without incurring any tax issues, which is not always the case with something like a mutual fund or individual stock. So for that reason and the many other that I listed, Roth IRAs are my #1 recommendation and get 5 Fisk faces. That's all we've got for you guys today. Again, hope you enjoyed it. Thank you so much for tuning in. If you haven't already, please make sure you're hitting that like button. Go ahead and subscribe for more content, and we'll see you in the next one.